Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, Washington, D.C. Metro, to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. So I know a lot of you guys out there are, trying to figure out whether you're even a candidate to refinance your home and to get these historically low interest rates. And some of the basic criteria that I would say is important to before, if you don't want to reach out to a professional, if you don't want to call me, I can give you some basic guidelines that will, let you know whether, even considering a refinance would be right for you. First thing is if you're trying to get a conventional loan, you need to be at least an 80% loan to value. Now, what that means is that your loan amount divided by what your house will appraise for needs to be at 80%. If it's not, you're going to have what's called mortgage insurance. And I'm sure a lot of you guys are familiar with mortgage insurance. Mortgage insurance really raises your payment up. And not to mention, you have to have substantially higher credit scores, typically 720, to even be considered for private mortgage insurance. Now, I know for a fact that even though, Fannie Mae and Freddie Mac guidelines will say that, you can get mortgage insurance down with lower credit scores, when you have the mortgage insurance company that come in, they re-underwrite the file, and they have credit overlays. So just because you may get a desktop underwriter approval, which basically is, the Freddie and Fannie guidelines, it may not still fit the bill for those mortgage insurance companies. That's huge because, like I said, mortgage insurance is not cheap. The second thing is your credit good enough? Typically, if your credit score falls below a 620, you will probably have problems qualifying for a new mortgage. Now, I'm not saying that you can't get one. I'm just saying it's going to be a little bit tougher, and you're probably going to have to consider, if you're a veteran, a VA loan or an FHA loan, which is another government-backed loan. You can go down to a 580 with that. Now, remember, that's just going to be a little bit more expensive because mortgage insurance on the FHA is going to be mandatory for at least 5 years. The next thing to consider is what are your financial goals as far as long-term and short-term? Where do you plan on staying put in that house for the next 5 to 10 years? Or do you plan on moving in the next 2 to 3? Because, those are... When you're looking at the costs associated with refinancing, it's really important to know what your long-term plan is, how long you plan on staying there, so you can actually calculate what your break-even is. I typically, as a rule of thumb, I like to tell people that if you can keep your cost and break-even in 2 years, then it probably makes sense to do. One of the last things is, what are your current loan terms? Meaning, did you take out a 30-year mortgage and now you're 8 years into it? Because if you are, then you probably don't want to have to reset that loan. This is one of the big mistakes that I know a lot of people made, and this is a lot of what went on during the boom of the real estate market, is that people would, buy the house, wait a year or two when the market, was cruising along, and then all of a sudden they would reset that loan to another 30, and then another 2 years later reset it again to another 30 years. So they were never paying down on these loans.
Nope.
Never. And I think that was the whole thing what we talked about the speculative investment. This is, if you're buying a home now, you need to commit to stay there long term, especially when, these interest rates are so low. I wouldn't want to get rid of that house probably ever. If I wanted to move, I'd probably rent that one out and buy another one. But interest rates might not be as low when I go to do that. So, you got
to get two now.
I know, that's the problem, Louis. I need to find the creative financing. I can't find it. Actually, I can find it, and as I've said on previous show for you guys listening, there's a lot of actual hard money lenders or private money lenders right now that are willing to give it to you, but you're going to pay 15, 16%. So, for people out there that are looking to get investment properties with so-called, they're not going to call it stated loans, but I just consider them no documentation loans. They're just going to require you probably put down 30%, but they'll lend you the money. And to be honest, I do that all day long too. If somebody wants to put 30% down, I'm willing to be the bank on that. 15, 16,
It almost
16%.
seems like loan sharking, though, that there's the stated rate or the official rate based on bank rate and all the general mortgage lenders is so low. But if you go into that market, the other market, you're going to have to pay much more, even if you put down 30%.
I know.
Which shows really, in a sense, what the free market is saying where interest rates should be. Why would you lend money and get no money back?
Exactly. Why would you want to make a return of 3 to 4%? They don't.
Well, that puts you into the stock market then.
Exactly, and that's why it just boggles my mind. That's why if I could, I would buy multiple houses right now. But obviously, with the way that everything, like I see, if you own, this is another question, and I'm glad you actually brought that up. But if you own multiple houses, and you're looking to qualify income-wise and credit-wise, if you have rental properties, you have to have claimed that rental income on your tax returns for at least the last year in order for that to be not counted, that full payment counted against your income. This is been a huge problem for a lot of real estate investors that own 20 and 30 properties, because their income is good, but when they have to start counting 20 different mortgage payments because they haven't been necessarily claiming for so many years, or they bought a lot of properties all at once and they don't have it on their tax returns, they got to count that against them, which makes their qualifying ratios shoot through the roof. So that's a huge thing, and I always tell people, when you have rental properties, to make sure that you're doing the right thing, putting them on your taxes, because almost all lenders and banks right now are pulling a 4506, which is a tax transcript. They're going to pull your tax returns and make sure that you filed them and they're accurate, because I've seen a lot of back when the market was going crazy, they wouldn't do that. They would just take your W-2s, you sign your loan paperwork, you get the loan. But now every single person is basically getting that tax transcript pulled, and if you haven't filed, then you're not going to get the loan. So it is very important, and this can really delay a transaction. I actually just had a client recently that I always ask, I'm like, have you filed your taxes? Are you current with your taxes? And he goes, well, define
current.
Yeah, define current. And basically he's, pushed back all the way to 2008. He's trying to get caught up. He's filed extensions, but he's 3 years behind. So I'm like, well, there's no way you're going to get a loan. No lenders.
Might get a knock on the door from the IRS.
He could. So, that is a critical component. I know that a lot of people are, I have a W-2. I'm like, that's great, but they're still going to pull your tax transcript. So, if you guys could take any advice, just make sure that you have all your I's dotted and T's crossed when you're going to fill out a loan application, because any of these little things can pop up and prevent you from getting the loan. The best way to do that, really, if you want to reach out at 877-245-2030, I can walk you through just the basic steps of where you should start if you're even considering. If you're renting and you're saying, okay, my timeline is I want to buy in the next 2 years. It's not too early to start talking to somebody about what your plan should be, or how do you go about trying to buy your first home, because if you start 2 years in advance, then you can really know, okay, is your credit up to par to be able to obtain that loan in 2 years? Are you going to have to pay off debt? Are you going to have
talking to someone like you makes total sense, because you really shouldn't just wake up in the morning and decide you're going to buy a house next week or next month.
Right.
You're talking about long-term planning, and that's what people should do with their finances.
Well, they tell you to do that with your 401k and everything else,
sure.
Right?
Which is far less the amount of money you're talking in your 401k is far less than what you're going to lay down on the house.
Absolutely. It's one of your biggest debts that you'll ever carry. And that's why I'm constantly talking to people, and they're like, well, yeah, I think I might buy in the next 5 years. Okay, well, if you're serious about that, then you should probably lay out some basic steps to be able to make sure that happens. Because all too often what really happens is people have like a goal of, okay, 2 years down the road I'm going to buy, and they need a down payment of a minimum of 3.5% if it's FHA, and then come 2 years down the line, guess what? How much money do you think they saved, Lewis?
Zero. And the other thing, Ryan, for you is someone may tell you 5 years. You may be able to talk to them, give them advice, and show them that it's doable in 2 or 3.
Or it makes sense right now.
Exactly.
And that's happened a lot lately. Actually, 2 of the clients that I just happened to been talking with this past weekend that are similar situations where they weren't really pressed. They were kind of like, I'm trying to make a decision, but I don't know if it's, if it's in the next couple months or if it's in the next year. I sit down and look at the numbers. One of the guys is paying $1,500 rent, and I'm like, okay, well, you're looking to buy, a $200,000 house. Your payment's going to be $1,300. He's like, $1,300? And I said, yeah, $1,300. So in his situation, it was going to be a net savings to him to buy this home. Now, he did have people are like, well, there's a down payment required. For this particular property that he was going to buy, it was out in more of a rural area. So the USDA loan, which is the U.S. Development, it's agricultural. So meaning if I believe it's over a certain amount of acreage or whatever, you can get this. And you can go on the USDA's website and look to see if the property falls within that. It's a 0% down payment for those homes. So 0% down, and he can potentially get the closing costs paid by the seller, which would really let him get into the house for next to nothing. Now, this particular client had money saved up. He's got $20,000-$30,000 where he could put down a down payment, but doesn't necessarily have to. So it's a win-win-win situation all the way around. You're talking about interest rates. When we were looking, it was probably about 4.25 or so. And he's like, well, I don't understand why I would wait if this is where it's at. And I said, exactly. I can't really argue with him at all.
And Ryan, let me ask you a question. Would you advise people to put less money down and take advantage of the interest rate and take that cash and either, I wouldn't say put it in the stock market, or put it into gold or silver, because the value of your cash will probably be better off somewhere else other than in the house, and you can still take advantage of the loan if you don't have to put as much money in.
Lewis, I'm not a financial advisor, but I would tell you if it was my own money, that's exactly what I would do. I never advise putting too much money into the home because you can't get it back out. Okay.
Right, and it's not earning anything.
It's not earning anything, and a guy that I've talked to a lot lately is saying he's just, he's buying as much gold as possible, and he really sees gold going to close to $5,000 an ounce at some point. And you take, eventually you do sell that, and inflation hits, you can turn around and sell your gold and buy as much real estate as possible.
Sure, and also if you look at gold's poorer cousin, silver, if gold goes to $5,000 an ounce, you're looking at a few $100s an ounce.
Yeah, and right now, silver I think is only at like $39, something like
40.
that.
The historic ratio is about 16-to-1 gold to silver, but right now it's about 40-to-1 gold to silver.
It's insane. So, yeah, that's a great option for people out there, though, is to take that money that you would dump into your home and you could, buy gold and silver and hold on to that and just wait for the actual inflation to take place.
Now, in the past performance, you would have made out like a bandit because both of those metals in the last few years have gone up hundreds of percent, whereas the cash remained at zero.
Yeah. And like I said, historically, there has never been one fiat currency that has not become extinct at some point.
In fact, they say the average lifespan of a fiat currency is about 40 years, and we're coming up on about 40 years since Nixon took the U.S. off the gold standard in August of 1971.
Yep. And we're coming up on a break. When we come back, we'll jump into some questions and emails of the week from listeners out there when we come back.